Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavita Baratake.
Good evening, everyone, and welcome to our webinar on tax planning for passive investors. It's very exciting to see all the syndicated investments where sponsors say, hey, there's cash flow, there's pref returns, there's 100% returns on the back end, all of that good stuff. I'm a sponsor myself, so I do make those I wouldn't say promises, but I do make those claims when we put our investments together, right? And there are a lot of tax benefits to real estate with depreciation, but a lot of people don't talk about the back end when there's recapture, when there is gains at sale. And personally, I'm coming to a point where a lot of my properties are selling and investors frequently reach out to me and say, hey, what about recapture? What about what happens at sale, right? So I kind of reached out to Brandon because I know he's the expert here. So Brandon Hall, he's the managing partner at the Real Estate CPA. And I see Brandon put together a lot of content and a lot of information on his Facebook group. If you aren't a part of it, you should join it. It's called Tax Smart Passive Investors, right, Brandon?
Tax Smart Real Estate Investors.
Tax Smart Real Estate Investors, thank you. So I think it's really important to be tax smart about it and not just go about like, hey, looking at the returns, but really what you make at the end of the day after all those taxes are really the net of what you're really getting, right? So I'm very excited to have Brandon on today to talk about this because he is not only a CPA, but he's also a real estate investor himself. And no one better than a real estate investor to talk about real estate, right? And tax planning for real estate. He recognizes that the real estate brings a lot of value to an investor's portfolio. As an entrepreneur, he knows what it takes to create wealth as well as protect it. But as a tax advisor, he understands how to minimize those taxes while maximizing compliance. Today, in today's webinar, you're going to learn about how real estate can provide you an income stream with tax advantages, what is cost segregation and bonus depreciation, how you can plan better for taxes used with syndicated investments, and who's a qualified real estate professional for tax purposes and why that designation matters at all, and what to expect and plan for when a syndicated asset is sold. So I'm really excited to have Brandon on the call today again because I'm going through the process myself where a lot of my investments are exiting. So from a perspective of a passive investor, because I'm a passive as much as an active investor, I'm very interested to learn about today's discussion here. Before I hand it off to Brandon, and trust me, I want to maximize our time with the CPA today. Just a few quick disclaimers. We always put together education, and this isn't for your specific purpose. It's a general educational purpose only. So for your specific tax matters, do get in touch with your own CPA or Brandon's available, Brandon's team's available. I'm sure they'll be happy to talk to you. A few housekeeping items. I ask that you type those questions in the Q&A box and not the chat box because it's just easier to moderate and make sure we get through all those questions. And my experience in doing this with CPAs is there are a lot of questions. Attorneys and CPAs are very popular on webinars. It's like people love free time with CPAs, right? So please do type those questions in the Q&A box. And the webinar will be recorded and sent out the link so you can go watch it. It's always put on YouTube and I'll share the link with you as well. To avoid the recordings and things to go to spam, please add my email, Kavita@Cherry Street Investments to your whitelist. A little bit about me. I started Cherry Street for primarily doing passive to help other people do passive investments, but also I'm a realtor. I have a real estate license. I help people buy active investments, mostly multifamily investments in Austin, Texas, San Antonio area. Besides that, I also do a life insurance, something called infinite banking, which people use to invest into passive as well as active investments through the life insurance policy. A lot of you folks know me. I do this education every 2 weeks. We talk about different topics, not just investing, but taxes and asset protection and others. So I focus a lot on education. I would love it if you could go subscribe to my channel here. It's Cherry Street Investor Education. Every webinar, every piece of content that I ever produce, which is short videos and everything like that, is on YouTube and on this channel. So really appreciate if you could go subscribe to it, and you'll be auto notified when I put in this new content like this webinar as well. So it's bit.ly/cherry-street if you want a short link to the YouTube channel. Quick update on upcoming webinars. We'll have a panel discussion on passive income, active life, essentially how people have created passive income for themselves because they're able to do the things they love and focus less on work and having a job. Also have premium financing with life insurance with a guest speaker. It's we'll be talking about how and why premium financing is attractive for what kind of investor it's very attractive. We'll also talk about residential mortgage, and I welcome any topic suggestions you might have. I'll find the right speaker for it and put it out there. I also want to talk, really excited about this. We're putting together a 2-day virtual conference on November 6th and 7th of 2021, upcoming soon. It's going to have a wide variety of topics, just like renewable energy, build-to-rent communities, all the latest and greatest, and what it means to invest in the post-COVID world. So I hope you're able to attend this. You can buy your early bird tickets at passiveinvestored.com. So I'm done with my quick plug for the event, but I just want to introduce myself really quick. A lot of new faces on the call today. I'm Kavita Bartake. I moved here from Bangalore, India in 1998. I am a tech person. I spent 20 years in tech, graduated with a master's in computer science and worked at IBM and the company called Atlassian before I moved over to real estate. Real estate really helped me financially free myself, and I'm kind of on this journey to help others do the same. Even if you love your job, hey, more power to you. If you love your job, why not create another source of income, right? So I started Cherry Street with that focus, is to educate people how to do passive investments, how to make save on their taxes and much more by bringing all these SMEs on board. So I'm not going to waste much time. Like I said, I want to maximize my time with our CPA. So I'm going to hand it off to Brandon and stop sharing here and let him introduce himself and take it forward from here.
Excellent. Thank you so much. I appreciate you having me on. I appreciate everybody in attendance for coming. Taxes is always something that I kind of think is funny that gets as much attention as it does because it's a relatively boring topic, but we try to make it fun. So thank you so much for spending some time with me this evening. And I also appreciate you switching up the time. I know that we're meeting a little bit earlier, right? Okay, yeah. Cool. Yeah, so thank you. I'm on the East Coast. I live in Raleigh, North Carolina. So this is a good time slot for me. I don't actually have a slide presentation because my son got sick today. And so I've been dealing with that all day and I was in the middle of creating it. So, but I do have kind of just a flow of how I want to do this. And so it'll be fine. I just don't have anything to distribute. But I am Brandon Hall. I'm a CPA. I'm managing partner at the Real Estate CPA. Get a little shirt there. It's cool. The Real Estate CPA. We have 23 staff that are nationwide. They're full-time. Sometimes people ask, are they contractors, W-2? No, they're full-time W-2 employees. I've got 3 partners at the firm. And we service real estate investors exclusively. So we don't take on any other clients. You got to be in real estate in some way, shape, or form. And we have clients in every single state. So we service the entire nation. Our firm is virtual. It's remote. So there's no office. All of our staff, I like to actually tell people we have 23 offices because all of our staff work out of their own offices at home. So they're all over the place too. It's a really cool environment. If you love technology, you would be a good fit. If you don't like technology, you would not be a good fit. But we try to help educate the masses on these different tax situations so that you can have better conversations with your own CPA. And that's my goal tonight is to that's my goal tonight is to help educate you on how these syndication investments work, not only so that you can have better conversations with the deal sponsors, but also so that you can have better conversations with your own CPA. So a lot of CPAs, they don't like cite the code when they're talking to clients, and we don't really cite the code either when we're talking to clients, because it's just you're throwing way too much at a client. They don't really care. But the problem is that the code citations, that's the accountability. And a lot of CPAs are just kind of like, they're just kind of meandering through this. They don't really understand it inside and out. And so I always ask people that are in our network, and you'll see it if you join our Facebook group, which I'll show you how to join later on. You'll see me saying, hey, ask your CPA for a citation, or here's the citation that you should be using, because that's the ultimate accountability to make sure that you're doing it right. So if you ever get this like gut feeling that you're not really sure if what you're being told is correct, you always ask for a citation. And that's what we do. And it just puts somebody on notice that, hey, it's cool, whatever you're saying, fine, I trust it, but I'm going to verify it at the same time. And it's a very professional thing to do. So don't ever feel bad for asking for a citation. What are you using to support the position that you're making there? All right. So I want to start off by talking about the general tax benefits of investing in real estate. I think it's a kind of a good primer for the rest of tonight's conversation. And Kavitha, just to be clear, do we have until 8 or 8:15? Sorry, 7 or 7:15?
It's fine, 7:15, which
Okay.
is, yeah, an hour.
Cool. Okay, cool. Well, hopefully I don't talk that long. I'll bore everybody. All right, so general tax benefits of investing in real estate. Let's just talk about a single family home. Everybody knows what a single family home is. It's just your primary residence. But let's say that I buy one as a rental property. So I go and I find this $300,000, 1,200 square feet or 1,500 square feet, or if you're in California, 20 square feet home, and I buy it, and I'm going to rent it out. So it's a rental property. I place it into service as a rental property. I paid $300,000. When I collect rent, right? So I'm going to get rental income coming in. Maybe it's $2,000 a month, so $24,000 a year. Get rental income coming in, and then I have expenses associated with that rental income. I've got my insurance, my property insurance. I've got my property taxes. I have mortgage interest. I have repairs and maintenance. I might have utilities. I might have advertising costs. I might have office expense, equipment. But typically, it's like the big few are property taxes, insurance, interest, and repairs and maintenance. Those are the big ones. I might have a property manager that's managing it for me. So I've got all of these expenses that go in to this property to keep it up and rolling, and just account for my ownership of that property. And let's say that all of our expenses are $20,000. Okay, so for the year, I've got $24,000 of rental income. All of my operating expenses are $20,000. And so I cash flow $4,000. And what I haven't factored in yet is depreciation. So depreciation is an additional expense that I get to claim every single year. Depreciation is an expense that is meant to track the deterioration of an asset over time. Now, a lot of people get confused with depreciation because they go, wait a second, real estate appreciates. Does it sound okay? Sorry, I just saw.
Yeah, I'm just checking in because someone said fix the sound, please. So just can someone comment? Can you hear Brandon fine? I can hear him fine. Okay, we can hear him, but there's a slight disturbance. Someone says, okay.
Is the disturbance coming from my? Hold on one second. Let me.
There is a flutter when he talks. He says. They say.
1 second. Yeah, I know what you're talking about. Were you hearing it?
Yeah, I think we can hear you fine.
Is it okay? Okay. Just let me know if that happens. Sometimes I have to reset my amplifier.
No, it sounds fine.
Using like one of these like fancy ones, so that's
Okay.
way out of my my knowledge level of technical audio. So
It sounds great now.
Cool.
All right.
So depreciation, it's meant to track the deterioration of the asset over time. And a lot of people get confused with depreciation because they go, wait a second, real estate appreciates in value, right? the price of real estate goes up over time. And that's due to a number of different factors that I'm not going to jump into right now. But depreciation is meant to track the asset falling apart, because it's true, real estate appreciates in value. But what's also true is that the roof falls apart over time, right? It has to get replaced at some point. The building falls apart over time. It has to get replaced at some point. So depreciation is meant to track that deterioration of the various components within the building. And it's a free expense that you get every year. So I buy this $300,000 building up front. When I make this $300,000 acquisition, I have to allocate some value to land, and then the remaining value is allocated to building. How do I do that? I pull up the property tax assessor card. You can Google the county that your property is within, and you can get those ratios. You apply it to your purchase price, and then I get my land value. So maybe my land value is $30,000, 10%. So my building value is $270,000. I then take that $270,000 and I divide it by 27 and a half years. Why 27 and a half years? Ask your congressman or woman. I don't know. But that's what they came up with. So 27 and a half years. So I'm depreciating $270K over 27 and a half years, which means I take right around a $10,000 annual depreciation deduction on this property. So every single year, I get to claim $10,000 of depreciation, regardless of how the property performs. Doesn't matter. Also doesn't matter how I paid for the property. That's a question I typically get. If I buy it all cash, does it change? No. If I put 0% down, does it change? No. You bought the property, you own the property, you get to claim $10,000 a year in depreciation expense for 27 and a half years. So if we go back to our example, we had $24,000 of rental income. We had $20,000 of operating expenses. So our net operating income is $4,000. And then on top of that, we have $10,000 of depreciation. So we get to tell the IRS that we lost $6,000. So $4,000 was our actual net operating income. $4,000 hit my pocket. But I get to tell the IRS when I file my tax returns, thanks to depreciation, that I actually lost $6,000. So I don't pay tax on that $4,000. Additionally, if I have other passive income, that remaining $6,000 loss that I get to tell the IRS about, I can actually use that $6,000 loss to offset my other income sources. And then you get into the passive activity rules, and we talk about that in our Facebook group all the time. People have tons of questions about that. But that's the holy grail. So the holy grail of real estate is getting this tax loss that, one, shelters my income. So my income from the source, right? So the rental income that I receive from this one rental property, I'm not paying tax on, thanks to the depreciation. And I'm not going to pay tax on it as long as the net operating income is less than $10,000 a year, because I get to claim $10,000 a year in depreciation expenses. Pretty sweet. But that additional loss of $6,000 in this example, again, $24K of rental income, $20,000 of rental expenses, $4,000 of net operating income. We had a $10,000 depreciation expense, which means that we're red, at least from a tax perspective, $6,000. So we're negative $6,000. So the real question, the holy grail of real estate investing, at least tax planning with real estate investing, is what do I do with that $6,000? And once you kind of learn about this and open your eyes to it, you go back and read Rich Dad, Poor Dad, and you realize, oh, wow, that is how you don't pay tax on your income, because you can do different things to make that $6,000 loss a $40,000 loss or even larger. And you can offset your W-2 income and your business income. You have to jump through a lot of hoops, and that's where the tax planning comes in. And we're going to talk about some of those things today. But just as a really high level, you get that depreciation. I want everybody to really understand that. The benefits of investing in real estate, even if you can't claim that $6,000 loss, is that I still was able to receive $4,000 of income that I did not pay tax on today. So awesome, awesome benefits of real estate. Now, we'll talk about cost segregation studies, because when I just talked about, you can take that $6,000 loss and make it a $40,000 loss. What I'm talking about are cost segregation studies. A cost segregation study is the practice of looking at a property and saying, hey, not all of the components within this property are going to last 27 and a half years. The roof might last 27 and a half years. The structure itself might last 27 and a half years, but the carpet is not going to last 27 and a half years. The appliances are not going to last 27 and a half years. And there's a whole list of these assets that do not last 27 and a half years. And a cost segregation study is the practice of going into a property, identifying all of those components and all of those assets that are within that property and assigning a value to them. So in our example, we said a $300,000 single family home. We assigned $30,000 to land, and we had $270,000 of building. But a cost segregation study is going to take that $270,000, it's going to break it down further. And it's going to break it into 5, 7, 15, and 27 and a half year property. Now, what is 5, 7, and 15 year property? It's just property that's depreciated over 5 years, over 7 years, over 15 years. So much like we depreciate a building over 27 and a half years because Congress wrote the rules, same thing. We depreciate different types of property over 5, 7, and 15 years because Congress wrote the rules. So a cost segregation study is going to look at your property, and it's going to allocate the building value to those various buckets. And then you're going to end up with this whole slew of value that you get to write off over 5 years. And you use an accelerated depreciation method. I'm not talking about bonus yet, but you use an accelerated depreciation method. But assuming that we don't even use that accelerated depreciation method, let's assume that we take $100,000 and we depreciate 100,000 of this 270K. We take 100,000, we write it off over 5 years, straight line, simple. We're going to get $20,000 of depreciation expense from that 100K for 5 years, and then we're going to get $0 from that 100K forever because we fully depreciated it. But we get $20,000 of depreciation for the first 5 years, and that's way more than the $10,000 that we previously talked about, and we're not even factoring in the remaining value that we haven't even allocated out, right? So people do cost segregation studies because they say, well, I don't want $10,000 depreciation every year. I want $20,000 or $30,000 or $40,000 of depreciation every year. And if you get like, let's call it $40,000 of depreciation, and then you factor that into our $24K of rental income, $20,000 of expenses, $4,000 net operating income. But if I've got $40,000 of depreciation expense instead of 10, now I have a $36,000 tax loss, not a $6,000 tax loss. And now I can use that $36,000 tax loss to offset my other income streams and to further save taxes. So that's why people accelerate the depreciation. They want to create these tax losses that they can then use to offset their other income streams. When you get a cost segregation study, you do this allocation, but you also get to claim bonus depreciation. You get to claim 100% bonus depreciation on any asset with a useful life of less than 20 years. Now, what did we just say? We said a cost segregation is the practice of looking at a building and taking value out of that 27 and a half year bucket and putting that value into a 5, a 7, and a 15 year bucket. 5, 7, and 15 years is all less than 20 years. So if I do a cost segregation study and I put value into my 5, 7, and 15 year buckets, because those are all less than 20 years, I can immediately 100% expense via bonus depreciation all of that value, Now, what does this typically look like? Well, it's typically 15 to 20% of the purchase price that you get to write off in year one for single family homes, 20 to 30% of the purchase price for multifamily homes. And then it goes up if you get into mobile home parks and gas stations and things like that. So we have a $300,000 single family home, and we've got a 15% allocation of that value to 5, 7, and 15 year property, thanks to the cost segregation study that we do. So we've allocated $45,000 to 5, 7, and 15 year property. We're basically saying $45,000 of this $300,000 is not going to last 27 and a half years. It's either going to last 5, 7, or 15 years. But thanks to 100% bonus depreciation, in year one, we get to write off the $45,000 allocation that we made. So now in this example, I've got $24,000 of rental income, $20,000 of operating expenses, a $4,000 net positive operating income. But then I also have $45,000 of depreciation expense thanks to first year bonus depreciation. So I have a $39,000 tax loss. And then the question becomes, how can I use the tax loss? Syndications do the same thing, but they have scale. So a syndication might buy a $10 million apartment complex, and that $10 million apartment complex might yield $3 million of bonus depreciation. So if you're an investor in that deal, if I put $100,000 into that deal, there's a high likelihood that I'm going to get $90,000 or so passed back to me as a loss. So if you invest in syndications, you get this at scale. And almost every single syndication that I know of is running cost segregation studies. And if you're a client of the real estate CPA, if the sponsors, we work with a lot of sponsors at our company, and we tell them all, you do the cost segregation study all day long. It doesn't matter if your limited partners can take the losses or not. You've got a duty to maximize tax positions, and you got to do that cost segregation study. So every single time they're doing these cost segregation studies, they're getting huge tax losses, and they're allocating those out to their limited partners. So if you're investing in a syndication, you need to figure out how much of that allocation I'm going to get. Because once you figure out how much that allocation you're going to get, that loss allocation, and we're going to talk about this, but once you figure that out, then you can ask the question of, can I take this loss? And what can I take this loss against? What type of income? I see a question in the chat here about W-2 income. We're going to talk about that. So how do you figure out how much loss is going to be allocated to me when I put $100,000 into a syndication? It sounds complicated, but it's relatively easy to get a pretty good guesstimate. So the very first thing that I need to do, I need to ask the sponsor, are they going to run a cost segregation study? Most of the sponsors are going to say yes. Most of the sponsors are running the cost segregation study during due diligence, or they have an estimate prepared for them. And what do I mean by during due diligence? I just mean before they actually close on the property, they're organizing everything. So they should have some amount of data that they can supply to you to answer this question. So it's, are you going to run a cost segregation study? And if yes, what percentage of the purchase price do you expect to write off in year one thanks to 100% bonus depreciation? What percentage of the purchase price do you expect to write off year one thanks to 100% bonus depreciation? So sponsor might say, yes, we're running a cost segregation study. We expect to write off 25% of the purchase price in year one thanks to 100% bonus depreciation. And now you know, okay, well, we're talking about a $10 million asset. So I've got $2.5 million of bonus depreciation at the partnership level. So this partnership is the one that's buying the property, right? So I've got $2.5 million of bonus depreciation at the partnership level. Then you ask the sponsor, how much capital are you raising? Now, most sponsors like to talk about that because they're hoping that you'll fill the entire pool, right? I'm raising $3 million. Do you want to put down $3 million? No, I don't have that much money. I'll put down 200 or 300, whatever. But you need to figure out how much capital you're raising in total. Then you need to go and look at the operating agreement. You can't go put money into a deal without looking at the operating agreement. So you have to sign the operating agreement in order to put money into the deal. And the operating agreement breaks down, here's how this partnership is going to operate, step by step by step. They're typically 50, 60, 70 pages. They're pretty dense. But you need to go and find the profit and loss allocation section. There's always a profit and loss allocation section. There's always a distribution section in these operating agreements. You need to go find those two sections and you need to read them. And if you're investing in a lot of syndications, you need to get really comfortable reading them. They are extremely technical. They're extremely complex. But once you read the first couple, you realize, oh, all these attorneys are using the same templates. So they're all relatively the same. So you put in the work up front to figure it out. You can work with a CPA. We help a lot of our limited partners sift through this stuff. But what you're looking for, you're looking to answer the question of this loss that's being passed to limited partners, or this loss that's being created at the partnership level. How is it being allocated among the members in the partnership? Because a partnership, an LLC, can allocate losses and can allocate depreciation however it wants to. There's rules, but as long as they meet the rules, they can allocate these losses however they want to. So I could own 50% of a partnership, but I could be allocated 10% of the depreciation, and my partner could be allocated 90% of the depreciation. I could own 50% of the property and be allocated 50% of the depreciation, and my partner be allocated 50%. So you have to read the operating agreement to make sure that you understand how these loss allocations are going to be made. Because you've already figured out that they've got a $2.5 million bonus depreciation deduction. You've already figured out that we're raising $3 million, right? So now we've got a $2.5 million depreciation deduction. You can get their projections on net operating income. Maybe they've got $100,000 of net operating income because we're buying it at the end of the year. Okay, so $100,000 net operating income minus my $2.5 million depreciation expense. I've got a $2.4 million tax loss. So I've got to go into that operating agreement and figure out how is that $2.4 million tax loss going to be allocated. Now, most operating agreements are going to allocate the losses to partners that have positive capital accounts. What does that mean? That means if I put $100,000 into the partnership, I have a positive capital account of $100,000. So I'm going to get allocated losses before the sponsor, who may put $0 in. I get allocated $100,000 of tax losses before the sponsor gets allocated anything, any tax losses, right? So the tax losses are typically allocated to the partners who have positive capital accounts before it's allocated to anybody else. And that's important to understand because it doesn't have to be that way. It can just be allocated 50-50, or it could just be allocated based on your percentage interest, right? So if I put $100,000 in and I get a 2% stake in this partnership, then I can be allocated 2% of the tax losses, or I can be allocated $100,000 of the tax losses, 100% of my contribution. So you got to read these operating agreements to understand how the tax losses are going to be allocated out. Once you understand how those tax losses are going to be allocated out, you can understand, or you can kind of come around to roughly what you would expect to see as a tax loss on your K1 that you're eventually going to get. Here's why. Let's say I'm looking at the operating agreement and it says, first, we're going to allocate tax losses to our members with positive capital accounts. Then we're going to allocate tax losses pro rata based on percentage interest. So first we're allocating based on positive capital accounts, and then any remaining tax losses we're going to allocate based on percentage interest. All right, well, if I've got a $2.4 million tax loss, because the syndication said I got $100,000 of net operating income, I've got $2.5 million depreciation expense, you net those two, I've got a $2.4 million tax loss. And then the syndication, the sponsor told me they were raising $3 million. What does that mean? That means that if I look at this operating agreement, it says we're going to allocate tax losses to members who have positive capital accounts. If we raised $3 million, then in the aggregate, when we look at all of the members of the partnership, we have positive $3 million of capital accounts. So we're going to allocate the $2.4 million tax loss to all of those people. They're typically going to be, it's going to be pro rata based on whoever has positive capital accounts. So they're going to allocate the $2.4 million pro rata to that $3 million. And we're going to have $600,000 left over, which is kind of irrelevant for this conversation. But what you get to take away from that is that if $2.4 million is being allocated to members who have positive capital accounts, and we have a $3 million positive capital account in the aggregate, then we're allocating 80% of somebody's contribution. We're allocating 80% back in tax losses, right? $2.4 million of tax losses divided by $3 million is 80%. So if I put $100,000 into the deal, I should expect to see roughly $80,000 of tax losses allocated back to me whenever I get that K1. Okay. I know this is like a little bit big, but watch the replay, get some real life documentation while you're watching the replay and go through it with me. Again, you'll start to see what I'm talking about. We've got $2.4 million of tax losses. We've raised $3 million total. So our positive total capital counts is $3 million. Our operating agreement says we're going to allocate those tax losses to members with positive capital accounts first. So the entire $2.4 million goes to all of our limited partners who have put money in the deal. But it's 80% of the total capital raised. So if I put $100,000 in, I can expect to receive about $80,000 back in passive losses and tax losses. So if I get my K1 back and it only shows $30,000 or $40,000, well, I've got a problem, potentially. Maybe not, but potentially, and I should look into it. So that's where you can kind of start holding people accountable, right? You can hold your CPA accountable. You can hold the CPA that's doing the sponsorship accountable. You can hold your sponsor accountable. If you look at that operating agreement and you understand how these numbers flow. And somebody in the chat, I know we've got Q&A questions as well, and we will get to those too, but somebody in the chat asked, what does positive allocated accounts mean? So positive capital accounts. So if I put $100,000 into a partnership, I have a $100,000 positive capital account. If I'm allocated a tax loss of $80,000, then my positive capital account remaining is $20,000. If we later earn income, then I'm allocated that income. Maybe we earn some amount of income and I'm allocated $10,000 because that's my stake in the partnership. So I get $10,000 of the entire pool of income that this partnership earns. Then my capital account balance, my positive capital account balance increases by $10,000. So your capital account balance increases when you make contributions. It increases when you're allocated profits. It decreases when you're allocated losses or when you take distributions out of the partnership. And a fun fact about the sponsorship side, so sponsors, this is a secret of the industry, not really a secret, but the sponsors, they can put zero money into the deal and have a zero capital account balance, but they can still claim tax losses due to debt financing and the rules around debt financing. They basically get allocated basis from the debt that is secured by the real property that we're buying. So that's why I'm saying you got to watch these operating agreements. If I'm an investor in a deal, that's great that I've got a great sponsor who has an awesome reputation and they're putting no money into the deal. That's great. But I'm putting 100K in and I want all the tax losses before that person gets anything. I'm selfish. I'm also a businessman. So that's what I want, right? That's in my best interest as an investor. I get allocated all of the tax losses until my capital account reaches zero. So I put $100,000 in, positive balance of 100. I get allocated at least 100K of tax losses, and then they can do whatever else they want. But I want my 100K back in tax losses. But sometimes there are operating agreements that will say something like, hey, we're going to allocate 30% of the tax losses to the general partnership and 70% of the tax losses to the limited partnership, regardless of who has a positive capital account balance. Okay. So if you take that same $2.4 million example, that $2.4 million tax loss and the $3 million capital account, and you get that type of operating agreement, well, 30% of that 2.4 million goes out to the sponsorship, right? And then the remaining 70 goes out to the investors. So you got to watch those operating agreements. It's not a bad thing for sponsors to get allocated tax losses. Not a bad thing. It's a bad thing when nobody sets the expectation up front. That's when it's bad. So we work with sponsors to help them really understand what they've got going on so that they can very clearly communicate it to their clients or to their investors. And as long as they do that, there's typically no issues.
Hey, Brandon, a quick question here about cost segregation. So typically what I understood always about cost segregation was that it's favorable once a property is a certain price from a cost benefits versus benefit standpoint, right? Like the cost of the study itself. And there was a question here about not having done cost segregation on any of the properties which have their own for several years. Is it too late? What's your take on that?
There's definitely a cost benefit. That $300,000 property that I'm talking about, we're not going to go get a full blown audit proof cost segregation study done. We're going to get a software study done. Costs $500. You can use KBKG's cost segregator tool or ELB's cost segregator tool. I don't get any money if you go use them, even if you drop my name. We don't take referral fees, and you have to be aware. You need to get audit protection if you're going to go use any of those software tools, because they have not been tax court tested yet. So there's risk if you're going to do that. But that's how you reduce your cost on the lower properties. Otherwise, you really shouldn't get if you don't want to do the software studies. We have clients that are like, no thanks, sounds too risky. And that's totally fine. If you don't want to do that, then you got to look at least at $1 million of basis. So I've got to buy probably a $1.2, $1.3 million property. And then I can get a real study done. The real study is going to cost $3,000, $4,000, $5,000. And it will make it worthwhile. Where it's not worthwhile. So all a cost segregation study is it's changing the years that we recognize depreciation expenses. That's what a cost segregation study is ultimately doing. Okay. So at some point, and we're going to talk about this at the end of this presentation, at some point, I'm going to sell the property. Maybe you don't, but if you're investing in syndications, they're going to sell the property typically 5 to 7 years later. So at some point, I'm going to sell the property, and I'm going to have to pay tax on all the depreciation that I've taken. On top of that, I pay tax on the appreciation, how much the market value has grown over time. So I'm going to pay all this tax on all that bonus depreciation, that 27 and a half years of depreciation expense that was sheltering my income. Well, now I got to pay tax on it. At some point, the tax bill comes due. So it's more of an interest-free loan than anything else. But it's still highly valuable when you apply the time value of money principles to it, because the whole theory is $1 today is not worth $1 tomorrow. What does that mean? Well, maybe $1 today buys a half gallon of milk, but $1 a year from now, the same dollar, I don't use it. I just stuff it in my wallet. And now a year from now, I pull it out and I go to the store to buy that same half gallon of milk. And now it's $1.03. And I can't use my $1 and buy that half gallon of milk. It's inflation. My capital erodes over time, right? The value erodes over time. So the same theory can be applied to tax losses. If I have a tax loss, I want to claim it today, if I can claim it today. Or if I have the ability to generate tax losses, I want to generate those today, not spread out over 27 and a half years. We work with some clients who are like, well, I'd much rather have $10,000 of depreciation expense over 27 and a half years than $45,000 of depreciation expense in year one and $7,000 of depreciation expense for the remaining 26 and a half years. And I typically go, no, you don't. If you put that into a spreadsheet, every single time it's going to tell you to take the 45K up front every single time. I don't care how you cut it. So it's just time value money principle. So you take the losses today if you can, but you can literally model this out. You can literally see how much money you're going to save even after you have to pay it all back. That's the beauty of spreadsheets. And if you really want to get that granular, I suggest talking to a CPA. In general rules, spend at least $1.2, $1.3 million if you're going to get the full big blown cost seg study done. And regardless of what type of asset you get a cost segregation study done, regardless of what type of asset or what purchase price, hold it for 2 to 3 years. And you're holding it for 2 to 3 years because the tax savings that you got in year one, you're trying to let those mature. You're trying to reinvest them. You're trying to earn something on them before you have to pay them back. So that's why you say 2 to 3 years. If you model out a cost segregation study and you're selling the asset within 24 months, it's typically break even, or you actually lose some money on it when you factor in those cost segregation fees. So be careful there. Great question. Any other questions along that note?
I think not. There are some about the how to apply the depreciation on other income. So I think
we're going to do that right now. Okay. So you spoke with your sponsor. You spoke with your sponsor. So you got the purchase price, you got the tax loss that's going to be allocated. You got the total capital being raised, and you got the operating agreement. You looked at that with your CPA, and you are estimating that 80% of the tax losses are going to be passed back. Every dollar that an investor puts in, 80% is going to come back to that dollar in the form of a tax loss. And you're thinking, I'm going to put $100,000 into this deal. So you put $100K in, and you're expecting $80,000 is going to come back as a tax loss. Now, the real question is, what do you do with that $80,000 tax loss? And can you use it? And that's where you have to apply the passive activity rules. The passive activity rules were made in the mid-1980s. And the whole purpose of the passive activity rules was to stop rich real estate investors from investing in real estate as a tax shelter. So what happens is this $80,000 that's being passed back to me is automatically deemed to be a passive activity because it's a rental activity. So it's a rental activity. It's a passive activity. It puts it into this passive bucket. The problem is all of my other income, like my W-2 income, my business income, my interest, dividends, gain on like Apple stock sales, all of that is in a non-passive bucket. So there's always two buckets of income. And you may not have even been aware of this, but it's been like this since the mid-1980s. And people that don't invest in real estate, they're subject to the exact same rules. So everybody is subject to these rules. It's kind of interesting to think about. Nobody realizes that they're subject to these rules, but everybody's subject to these rules. Every single dollar is going to be in the passive bucket or in the non-passive bucket. It's got to be in one of those two buckets. Rental real estate losses are in the passive bucket. My W-2 income, my business income, everything else is in the non-passive bucket. The problem is that losses in that passive bucket cannot offset income in the non-passive bucket. Instead, losses in my passive bucket get suspended and they carry forward until I have passive income, until I have income that flows into that passive bucket. Another way around this, though, is that I can actually recharacterize the $80,000 of passive losses, and I can move them over to the non-passive bucket. And we'll talk about that in a second. But really important to understand that this $80,000 coming back to me, it is going to be, by default, a passive loss. And unless I have other passive income, then that $80,000 is going to be suspended and it's going to be carried forward. It's carried forward indefinitely until the day that you die. Your heirs can use it on your estate tax return if you never actually get to use it, so they get a little bit of a benefit. But it's suspended, carried forward. It can only offset passive income.
Can it offset all passive income? Like let's say I had another deal where I didn't have enough, or I took losses initially, but I still have passive income coming in from that other deal. Can it offset that?
Yes, it can. Yep. So if I'm involved in multiple syndications, or let's say like a lot of our clients invest in ATM syndications, right? So they buy these little ATM machines and then they get all this passive income coming back. Well, the sponsors tell them, oh yeah, it's business income. Well, that doesn't matter. I don't care about business income or rental income. All I care about is it passive or is it non-passive? And that income is still passive. So you could go and invest in like an ATM syndication, for example, get $10,000 of positive income back, then go invest in this real estate syndication, get an $80,000 tax loss. They're all passive, so they're going to net out, and now I'm carrying forward $70,000 of losses. Or maybe my real estate maybe I'm involved in multiple real estate syndications, and one of them liquidates. And when they liquidate, I have to pay back all that depreciation. I have to pay a tax on that depreciation, and I have to pay gain, right? So I've got gain and I have depreciation. It's a big chunk of money that's going to come out of my pocket whenever the syndication liquidates in 5 to 7 years. But if I have suspended passive losses that are being carried forward, those suspended passive losses can offset the gain from the syndication.
Is the gain from the syndication not a capital gain then? Is it all passive?
It is, but yes, it's both. It's both. So it's a passive, the way to think about it is it's a passive capital gain. So the way that you report it and the way that it flows through those passive losses first, and then it gets reported on your Schedule D. The net gets reported on your Schedule D.
So in that sense, let's say an investor's investors in a syndication which sells, and they have depreciation recapture, and they have to deal with gains from the sale. Now, let's say in the same tax year, they go make another investment which generates a big passive loss. So those two will offset each other then?
Yep. It's beautiful. And so if you're investing in syndications, and you're hearing this and you're following along, you're probably thinking, okay, so the strategy to invest in syndications and not pay tax for a really, really, really long time, like decades, is to just always churn the money. Okay, so if a syndication liquidates today that I'm involved in, what am I doing? I'm looking for another syndication to invest in before the end of the year, so that the bonus depreciation from the new syndication will give me a nice tax loss that I can use to offset some or all of the gain from the syndication that liquidated today. So it becomes a timing strategy. And you typically want to make investments over a number of years, right? So if I have the opportunity to invest in 2 syndications in December 2021, or 1 syndication in December 21 and 1 syndication in January 2022, I'm going to split it between 2 years. I mean, all things equal, like assuming that everything else is fine, I'm going to split it between 2 years because I want to spread out my eventual potential gain recognition. I want to pad my losses, and when you get into it, it's not as complicated as it sounds. It's just really just trying to figure out, all right, if something's going to liquidate every 5 years, then I'm just always going to be buying syndications every year to create these big losses.
So I have another question, Brendan, kind of along the same lines. So let's say I'm a passive investor. I put in 100,000. I generated $80,000 loss in the syndication. Now that year, I only had, let's say, $10,000 in passive income. So I was only able to use 10,000 of that 80,000 loss to offset. So I carry that 70,000 forward, and next year the same thing happened. Let's say the next 5 years until the syndication sold. So now I have a $50,000, not 50, but 80 minus 50, still a negative $30,000 loss that I carried forward. Is that right so far? So let's say I had $10,000 in income for 5 years.
Yes.
Right?
Yes.
Passive income. And then I had an $80,000 loss. So I have a negative 30. Right? Yep. So let's say that year the investment sells. So is that negative 30 also used against the depreciation recapture?
Yes.
Okay.
Yep. Yep.
That's good to know. I always had that personal question, so I had to ask.
Yeah. And honestly, like a lot of CPAs will say, no, it doesn't work like that. A lot of CPAs will say your passive losses from a real estate syndication cannot offset your passive income from a business. And it's just all false. All you have to do, if you get a CPA that's telling you it doesn't work like that, or if you get a CPA that says, hey, your $80,000 of passive income or passive loss, there's $80,000 of loss from this real estate syndication, it can only offset real estate income. It can't offset the $10,000 that you earned from investing in a local hair salon. But if I didn't materially participate in that local hair salon, it's a passive activity. And the only thing that matters is that there's 2 buckets, passive and non-passive, and it flows through that passive bucket and they net out. And if you get a CPA that says, no, it doesn't work like that, you just go and ask them to prepare, you say, can you prepare a pro forma tax return, right? A projected tax return. That's what a pro forma is. And I specifically want to see Form 8582 filled out. And when they prepare Form 8582, they will realize, and they will tuck their tail between their legs, that they do net out. And this is you have a lot of physicians in the attendance here, right? Okay, I'm assuming everybody is physicians. Okay.
No.
No? Okay. Well, we work with a lot of physicians. And in the physician space, this gets really interesting because there are tax court cases that say if you are a surgeon, for example, and you invest in the surgical center where you perform surgeries, so this is like an opportunity for a lot of physicians. They're able to take a slice out of, or they're able to invest and take a stake in the hospitals, the groups, whatever that is. If you're not materially participating in that activity, then the income coming back from you, the surgical center's income, is passive. And you can use rental real estate losses to offset that income. You don't even have to worry about real estate professional status. If you start doing research on this, you're going to find all this information about real estate professional status. You're going to find all these physician groups that say, oh, real estate professional status is amazing. You got to be a real estate professional. Everybody's going to be a real estate professional. It's going to be so much fun. But the reality is that you can work way less harder than that, and you can get all the same tax benefits if you structure your income streams correctly. So you can take a passive stake in a surgical center or in a business that's completely unrelated to real estate. And as long as it's passive, it's going to flow through that passive bucket, and it's going to be netted out against your passive losses that you get from your other real estate investments like syndications. And this is super powerful because if I invest in a surgical center and I earn $100,000 in 1 year, we have an amazing year. I earn $100,000 from the surgical center. Well, guess what? Now I got $100,000 that I can go put into a syndication. So I got to put $100,000 into syndication, get an $80,000 tax loss, and now I've got a $20,000 net income that I got to pay tax on. Awesome. It's so awesome. When you get into that type of planning, and that's like multi-year sort of planning, because it kind of makes you think bigger. Like, okay, wait a second. What are my opportunities to own passive businesses? You talk about, you look at any rich people, like any uber wealthy people. We have a few clients at our firm who have 300, 400, 500 million dollar net worths. They crush it in real estate. Real estate's their number one focus. They love real estate. But guess what? They have passive stakes in businesses, hundreds of businesses, random businesses. And all they're doing is all this income's being generated. They're getting all these checks, but then all the real estate losses are offsetting it. So it's just something to think about. All right. So when a syndication liquidates, 5 to 7 years later, syndication sells. What happens? Well, if I put $100,000 in and I got an $80,000 tax loss back, my basis, my capital account is now $20,000, right? Put $100K in, reduced by an $80,000 tax loss. My basis in the syndication is $20,000. And let's assume that I just got zero for the next 5 years. The syndication just kind of stunk, no good cash flow, big repositioning strategy. Maybe it didn't stink, just a lot of repositioning, a lot of cash being spent. So I got zero, absolutely zero, perfect break even for the next 5 years. Then in year 5, they liquidate. And they give me my share of that liquidation in total is $150,000. So I put $100K in. 5 years later, I'm getting $150K back. Okay. 50% gain over 5 years. Pretty good. The question is, what is my tax? What is my gain that I have to pay tax on? Well, if I'm getting a total of $150K back, but my basis is only $20,000 because I had the $100K investment reduced by $80,000 of losses. So now my basis is only $20K. I'm going to have a gain that I have to pay tax on of $130,000, right? And if I get a check of $150K and I have gain of $130K, so I get my $100K back plus my $50K of gain. So I get a check $150, but then I've got a gain of $130. And let's just say I'm in a top tax bracket. A lot of that check is going to go to taxes. That's what it's going to feel like. A lot of the checks are going to go to taxes. And this is where people are they have very short-term memory. They forget about all the benefits up front of investing in the syndication and getting the depreciation, using those losses, right, against your other passive income when that tax bill ultimately comes due. And they get mad and they forget that all that stuff happened. In reality, the wealth has grown and you're probably fine. But that's how you're going to calculate that gain. So at some point, I'm going to sell that syndication for $150K. My stake's going to be worth $150K. I'm going to get that back, but I've only got $20,000 of basis, so I've got a $130,000 gain. Now the problem is, of that $130,000 gain, $50,000 is 1231 gain, Section 1231 gain. Section 1231 gain is an Internal Revenue Code citation or section, and that is capital gain. That's my 20% tax rate. So $50,000, the actual appreciation. That's the 20% capital gain tax rate. The remaining $80,000, so $130K, 50 of that is capital gain. The remaining $80,000 is depreciation recapture. Some of that depreciation recapture is going to be from bonus depreciation. Maybe most of it is from bonus depreciation. Bonus depreciation is recaptured at your ordinary tax rate. So right now, the top tax rate is 37%. If the Biden tax plan passes, it could be 39.6%. So you recapture your bonus depreciation deduction at your ordinary tax rate. That's very oversimplified. So if you go and ask your CPA, oh, I was on this thing and this guy said the way, there's a lot more to it, but that's kind of the summary level. So this $80,000 could create a lot more tax than my $50,000 of gain does, of capital gain does. So you just got to be aware of that. Now, if I had that $80,000 tax loss at the beginning and I didn't have anything else that I could use to offset it, and it was passive, then it gets suspended and it carries forward until I can use it. So I've carried forward this $80,000 tax loss that the syndication passed back to me every single year until I can use it. Well, guess when I can use it? Whenever that syndication sells. So the syndication sells. My basis in the syndication is only $20K because I was given an $80,000 tax loss. Sells for $150. That's my share. So my gain's $130. But when I do my individual tax return, I get to apply my $80,000 of tax loss that I never got to use. I get to apply it to that $130K of gain. And now I'm left with $50,000 of capital gain. And now I just pay 20% of that, $10,000 on that.
So is the 1231 gain always at 20%, Brandon, or is it 15 to 20, the long-term gains?
Yeah. So long-term gains is 15, 20, depending on your income level. If you're at the 20 level, though, you also have the net investment income tax is 3.8% tax.
So
somebody said that 39.6% is no longer in play. I haven't actually seen anything as of like 3 hours ago that confirms that. So as of 3 hours ago, it was still in play. So I don't know where that came from. Sorry, go ahead.
Oh, so the net is really you're paying the 12 gains on the 50K, which is your 1231 capital gains.
Yes.
If you carried that 80,000 depreciation.
Yes. Yeah. So when you liquidate, when a syndication that you've invested in liquidates, you're going to pay the 20% long-term capital gain rate, unless the Biden plan changes it. You're going to pay that 20% long-term cap gain rate on the appreciation, the value of that appreciation. And you may also pay depreciation recapture tax on the depreciation that you were able to personally claim when that tax loss was passed back to you. Does that make sense? So if I was never able to claim the tax loss, I don't have to worry about that depreciation recapture. Most likely. I might have a little bit of it, but it's typically not one-to-one, but not that big of a worry. But when I'm able to use that tax loss, I invest in the syndication that I originally invested in today, or that I invested in a few years ago. It liquidates today. And I've got this big gain. And in December, I find a new syndication to invest in, and it creates a tax loss that offsets this gain. Cool. The new syndication that I invest in 5 years from now, it liquidates. But now I don't have any tax losses to offset that gain. So I'm going to pay depreciation recapture tax at that point. So, and even though you can't 1031 exchange partnership interest. So if I invest in a syndication, I own a partnership interest. I don't actually own the underlying asset. That's how it works. So I can't 1031 exchange my stake technically, but I can kind of run a 1031 exchange without running a 1031 exchange, right? The syndication liquidates today. It gives me a $100,000 taxable gain. That's what's allocated to me. And I find a new syndication to invest in December. Now, I'm not doing a 1031 exchange. I'm just putting 100K into that syndication. 100K of my own money. There's no exchange. But that syndication is going to do the cost seg. They're going to get bonus depreciation. They're going to pass back a large loss to me. And because my passive losses can offset my passive income, I effectively kick the can down the road via kind of a roundabout 1031 exchange. It's kind of how you think about it. So you're not really doing a 1031 exchange, but you're accomplishing the same thing. You're just kicking your gain down the road. I've got this big gain from a syndication that liquidates today. Well, if I have enough money on hand to go invest in a new syndication, then it's going to create a tax loss, so I don't have to pay tax on the gain today. But that new syndication investment, because I took such a big tax loss, my basis is really low. So when that new syndication investment liquidates at 150K and my basis is 20, then I'm going to have a $130,000 gain. And so then I've got to go and invest in a new syndication to offset that gain. And you just slowly kick the can down the road.
Well, similar to a 1031, right? You're just kicking the can.
Yep.
Is there any rules around like 1031? If someone passes away, then basically the cost basis gets reset, right? So what happens if you keep kicking the can down the road and let's say your heirs get your property? Does that reset or?
Yeah.
Okay.
So stepped up basis as of today. Yes.
Okay. So it's similar to 1031 in that sense.
Yeah.
The basis gets stepped up. Okay.
Exactly. Mm-hmm.
Okay.
Yep.
And I think the last topic was qualified real estate professional.
Oh yeah. Yeah. So the whole passive losses thing that we're talking about, passive buckets versus non-passive bucket, those two buckets of income, that $80,000 tax loss that we've been talking about throughout this webinar, it's by default passive. So it's going to be in that passive bucket. And my W-2 income, my business income, everything else is in the non-passive bucket. And that's not always optimal, right? Like we kind of talked about the time value of money theory. $1 today is worth more than $1 tomorrow. So to optimize, I want to use the tax losses today. I want to be able to fully utilize the $80,000 of tax losses today. So the question becomes, if I don't have any passive income, or if I don't have a syndication that's liquidating for this $80,000 to be offset against, then it's going to be suspended. But how do I avoid that? How can I move the $80,000 out of the passive bucket and into the non-passive bucket? And a way to do that is to qualify as a real estate professional. Actually, the only way that you're going to be able to do it with syndications is to qualify as a real estate professional. You're not going to be, a lot of CPAs say, oh, you can use the $25,000. There's a $25,000 passive activity loss allowance if you're earning less than 150K, but you can't use that with syndications because of the ownership test typically, and the participation test. So you have to qualify as a real estate professional if you're going to successfully move the $80,000 out of the passive bucket and into the non-passive bucket. And in doing so, you'll be able to offset W-2 income, business income, gain on stock sale, interest, dividends, that type of thing. But qualifying as a real estate professional is tough. A lot of CPAs and real estate educators make it seem very easy. We've seen it, especially in the physician space. And so I would just be really careful with that. You got to make sure that you get really good information. We talk about it a lot. We have a 4-part podcast series on it. So if you check out the Real Estate CPA podcast, look for REPS, REPS, and those will be the episodes. It's a series back to back to back. You can listen to it top to bottom. It'll talk about everything. It'll talk about all the misconceptions, the risks, everything that you have to do to document it. So if you're interested in moving the $80,000 out of the passive and into the non-passive bucket, that's what you have to do. It is harder than a lot of people make it seem. And the reason that it's harder than a lot of people make it seem, you always have to think about what's in it for somebody else. Okay. So I'm a tax pro, right? If I want to go on a big marketing campaign and I want to get everybody super excited about using my services, what am I going to do? Well, I've got to figure out ways to get you excited about tax. So maybe I talk about how easy it is to qualify as a real estate professional and offset your high W-2 income. But I don't really go into all the details until you purchase whatever it is that I'm selling. So just be careful, because we've seen a lot of people over the years kind of get hosed, for lack of better words there.
Yeah, I had an investor ask me today if they can become a realtor and get the qualified real estate professional status. And I'm like, no, I wish it was that easy.
Yeah, yeah.
Everybody would be getting a real estate license to get that, right? So,
Yeah, yeah. And the other thing too to think about, in this Biden tax plan, there's an $80 billion budget allocation to the IRS. So it's increasing their budget by $80 billion, which just means more audits for rich people. And guess what? People that invest in real estate are richer people. So there's gonna be more audits coming over the next few years. We've been in decades where people have not, like the past decade and a half, people have not feared the IRS, and I think that is going to start changing as we go along. So, if you hear about these awesome things, you can trust, but always verify. You can come to our Facebook group and ask there. We give citations out so that you can go back to whoever it is you're talking to and say, well, wait a second. Brandon's Facebook group, they said, here's the citation. So what's your citation? What's your position? That's the whole purpose. It's not to be mean to other CPAs. And CPAs always get so defensive when you challenge their positions. It's so ridiculous to me, but they do. They just get so emotional. It's like, dude, we're just all learning together, right? We're just all trying to figure it out. Taxes are so complicated. I feel like I'm really good at the passive activity rules. I learn something new every single day. So you gotta open your mind. You got to be receptive to it, but a lot of CPAs aren't. So we'll just give you citations and you can go right back to your CPA and go, well, here's the citation. What's your citation? If they can't give you one, then there you go. That's your answer.
So I think being mindful of the time, I'll take some of the questions here and just talk through that.
Cool. I've got time.
Why does it make sense to invest in real estate syndication when end up paying back capital gains and depreciation recapture in the time of selling? Instead, I can just buy single family homes and keep doing 1031 exchanges and pass it on to the kids after me where they get a step up in basis. Isn't that better? I think we kind of answered that, but
well, let me talk about that so we work with a lot of clients that invest in a lot of different, we have 700 some clients. They invest in all sorts of different real estate activities. They've got development deals, land deals, single asset deals, funds, everything. I think what it really comes down to is how much time do you personally want to spend managing an asset, finding a good deal and managing the deal. Most of the syndications that we see are able to produce returns of 12 to like 25% sometimes, especially in the recent couple of years. It's been much higher as real estate prices have been ramping up. And like in today's hot market, we're seeing a lot of sponsors liquidate way earlier than they expected because they're getting sweet deals that they can't pass up. And they turn out to be like 30% internal rate of returns. Your internal rate of return is your true return that you basically earned every single year. So the question simply becomes, can I replicate that same return by myself? Do I have the skills and the network to replicate that same return by myself? And is it worth the amount of time that I'm going to invest to replicate that return? That's really the question. So I always tell people, don't let the tax tail wag the dog. Put the taxes aside and just ask, do I have the time to commit to this, to build it out myself? And do I feel confident enough that I'm going to be able to get those returns? And when you take a look at that latter question too, I'm a pretty confident dude, and it bites me a lot. so you got to also try to be very objective with yourself. You got to really understand your weaknesses, and you got to kind of just, wave the white flag sometimes and say, you know what, this ain't for me. I can't do this. I don't know what I'm doing here. So I got to hire this out. I do that all the time in my CPA firm. There's a lot of things in my CPA firm that I have no idea how to do. And what do? I go and hire somebody to get the job done rather than trying to do it myself. So it's just business. You're just running the business. So how do you get the best returns possible? That's really the question. Makes
sense. And as a sponsor, I want to say this as well, right? I own single family homes too. And honestly, I don't cash flow on most of them. That's the truth, right? I pay so much in property taxes in Texas that I don't really cash flow.
Oh, yeah.
So there's that to be asked too, really. What is your cash flow at the end of the day? And what is your appreciation at the end of the day, right? In single family homes versus what is the sponsor able to generate for you? And also with the way we talked about is there is an opportunity for you to reinvest and create depreciation again So you are literally kicking the can down the road, just like 1031 exchanges. So I think maybe that question was asked before we talked about that. All right, a lot of questions here. I don't know if you want to pick something that you want to answer. I want to be mindful of your time, and I know you have a sick kid at home as well. So thank you for being here first.
Yeah, no problem. I think he's actually down now. So yeah, are there any in here that are relevant?
Let's see. Can you cover the recharacterization of passive losses to non-passive bucket? I think that's just the REP stuff. You can go to Brandon's website, and there's a whole bunch of information on that. That is the realestatecpa.com, I believe.
Yeah. So if you go to the realestatecpa.com, we actually have a 12,000 word guide on real estate professional status. You know, I was talking about how people keep getting like the wool pulled over their eyes with all these marketing schemes. Well, we sat down and wrote, it's like a 36-page ebook. You can download it or you can just read it online, whatever you want to do. But it's like a 36-page book, and just top to bottom walks you through everything, because we don't want you to end up on the bad side of an audit. I'm also I just chatted out to everybody a link to our Facebook group, Tax Smart Investors. Highly recommend you go join that, because if we don't get to your question now, you can jump in there and ask. There's 3,300 real estate investors in the group, and there's just a lot of good activity. It's really
I'm a part of it, and I can vouch for that.
Thank you.
This is a good question. I think this would be useful for a lot of people. If I sell a single family rental home with a gain of 50K, and in the same year I invest into a syndication which generates a passive loss in excess of 50K, can I use that loss to offset the long-term capital gains I owe on the sale of the single family rental?
Yes, you can, but the excess loss. So you said you've got a gain of 50, and then let's just say you've got a passive loss from the syndication of 70. You can use 50 of the 70 loss to offset the gain. The remaining 20 will be suspended and carried forward. Yeah.
So the answer is yes.
Yes. And what did you just do there, right? You effectively did a 1031 exchange. That's essentially what you just did. Because
without the rules of 1031 exchange.
Without the rules of 1031 exchange.
45-day identification and 6-month close and all of that stuff. The only catch is you have to do it in the same calendar year, right?
Got to do it in the same calendar year, yes. Yep. Yeah. But people are all syndications are always looking for money. There's always deals out there. So
all right. This is a good one too. As a passive investor who cannot use depreciation to offset W2, isn't it better to do straight line depreciation to offset rental income and pay capital gain rather than pay capital gains? And pay capital gains than depreciation recapture at exit?
Yeah, that's a really good question. And I'm going to talk about my personal my personal experience with it. My personal recent experience with it. Sorry, I'm getting, bam, there you go. So I have 24 units now. I have 10 duplexes that we just acquired this year. I've got a beach house, short-term rental. I have a 3-unit and a single family home. That's 25. Is that 25? That's 25. Okay. And so these 10 duplexes we just acquired. We acquired them for we being me, and I partnered with my parents. We went 50-50 on this deal, $1.4 million acquisition. And the question is, do we do a cost seg study and get the bonus depreciation? And you can apply the same thought process to a syndication too. Like if I put 100K in a syndication, I'm going to get an $80,000 tax loss back. How does that help me if I can't actually use it? For me, it's looking like we're going to do it anyway. And here's why. I have one of my 3-unit my only 3-unit property. I purchased it in 2015 for like $90,000. And it's now, I could sell it today for $270,000. And if I ever become a real estate guru, it's the only property I'm ever going to talk about because it's such a great win. I have had many failures, so don't get me wrong. I am not a real estate genius. I just got really lucky. But by all means, if you ever see me selling a real estate course on how to buy real estate, that's the one property that I will ever talk about. And it'll be the only thing that I teach on. But anyway, so if I have large amounts of passive losses that have been suspended and carried forward, and we have a large run up like that, like we have like last year and the year before that, where just prices are just going sky high, demand's crazy, I have the flexibility to pull the trigger on a sale and not have to worry about a 1031 exchange, right? So and that's a large gain that I would want a 1031 exchange. So if I can create large suspended passive losses, even though I'm not going to use them today, I might not use them next year, I might not use them for years. What it does though is it just gives me a large cushion to sell my other real estate into, and it just allows me to churn the cash, because I'm a real estate investor for life. So if I sold that property, I would take the cash and I'd go buy another asset. But it just allows you to churn the cash without having to go through the rigmarole of a 1031 exchange. I was talking about this one time, and somebody was like, man, you really are anti-1031 exchange. No, I love 1031 exchanges. I really do. They're like the greatest gift to real estate investors. But I also recognize that they come with rules, and I don't like rules. So if I don't have to follow the rules, if I can do it a different way, then I'm going to go do it a different way. So to answer your question, you just have to ask yourself, what's your personal like acquisition plan? If you're just going to buy one property and that's it for a number of years, then yeah, you probably don't need to go through the rigmarole of a cost seg study and creating these big passive losses. But if you're planning on, I'm going to buy a property this year, another one next year, I'm going to try to scale this thing up, what happens is over the next 5 to 8 years, the original properties that you purchased, you're going to see in a lot of areas, or at least today, what's happening is people that purchased property back in 2015 are seeing gains like I just talked about, like large gains. And these losses can help make decisions easier if I want to liquidate that portfolio and reapply the equity somewhere else.
That makes a lot of sense. This one's a good one. Personally, I think I would have that question too about the depreciation. I mean, bonus depreciation phasing out. I can't find the question now. So can you talk a little bit about the bonus depreciation phase out?
Yeah. 26, 27. I think it's.
What does that really mean to an investor, a passive investor?
Well, it's not going to be much until I think it's like 2025. So bonus depreciation, it's 23, it's 80, 24, it's 60, 25. It's.
So what does that mean? Like it's 80. Does that 100% bonus depreciation now reduce the amount to 80?
Yeah. So in 2023, it's not going to be 100% bonus depreciation. It's going to be 80% bonus depreciation. And then in 2024, it's going to be 60% bonus depreciation. 2025, 40, 2020, and so on until.
So that's the year one depreciation. So let's say you took all your 15, 7, and 5, 7, and 15 buckets. You can only take 80% of whatever gets into that bucket. Is that right?
Yes. Yeah. Okay. And then you would be depreciating the remainder over 5, 7, and 15 years. Yeah.
Okay.
So it's probably not going to be a huge deal until probably 2025. That's when you're going to start seeing sponsors kind of start turning around and going, okay, on the new acquisitions that we're doing, how do we talk to investors about the tax benefits? Because it's not as easy as just saying, yeah, we get to 100% expense $3 million of this $10 million acquisition. Now it's going to be, I've got to explain what a cost segregation study is, because cost segregation studies will still be highly valuable. They're just not going to be as valuable. You're still going to see them all the time. We would still recommend that they do it. Even if there was zero bonus depreciation, still recommend you do a cost segregation study.
Right.
But it's not going to be like, it's just, you're going to get the benefits over 5, 7, and 15 years, not in year one. So time value money perspective, it just becomes less beneficial.
Got it. I know we are kind of at the top of the hour and actually beyond the hour. So I know there were a lot of questions about UBIT, but that's another whole topic in itself. I don't even want to talk about UBIT today, but maybe Brandon can come back in part 2 of this and talk about UBIT. And there's a lot of controversy right now with what Biden is doing with IRAs. So I would love to have you back on, Brandon, to come talk about that and share your perspective on what's going on.
We're actually going to, so if you join that Facebook group that I posted, it's Tax Smart Real Estate Investors. I put the link in the chat. We do a Facebook Live now once a week. Our first one was yesterday, and it was a disaster. I mean, it was great. It was great. It was just the first 7 minutes I couldn't figure out how to make it work. But that's okay. We got the first one behind us, so all the others are going to be smooth. We're going to do it once a week, and we'll tell you how to access our Biden tax webinar if you join those live Q&As, because we're going to run a Biden tax webinar probably first week of October, assuming that the legislation is like more finalized than it is today. I never get super worked up about legislation until it's actually being voted on, or it's very close to a vote, and we're nowhere near it yet. So I think that a lot's going to change before we actually get a vote. We might even see the stepped up basis jump in. There's nothing about 1031 exchanges in there, so we'll see some changes, I'm sure.
Awesome. That was amazing. Thank you so much. I know I learned a lot. I hope everybody on the call learned a lot today. Also, put in the Tax Smart Real Estate Investors link in the chat box again, because I think Brandon had only sent it to the panelists, so you might not have seen it.
Oh, my bad.
No, it's fine. It's fine. I just put it in again. Please make sure you click on it before we close the chat today, or the presentation today again. Thank you so much, Brandon, for sharing all this information. This was one of the clearest tax person talking without any, usually tax people get into weeds and we're like, okay, let's bring them back. We just want to understand it from, a non-tax perspective, meaning that we're not, I love the citations and, support, but sometimes I just want to hear plain, English.
Right.
Right. I do appreciate it. Like dumbing down for us, right? Dumb it down for us. So this has been very useful. So thank you so much again. On behalf of everyone on the call, I know they're saying it's thank you as well. And thank you everyone for taking time out to be here. This session will be recorded and it'll be put on YouTube. So please go there if you want to actually take the numbers. And I loved this, what Brandon said about looking at the operating agreement. A lot of people just sign, click, 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 and they're done, right? And one of the things I am putting together also for the virtual seminar that we have is how do you understand the legal documents, right? Like the operating agreement, the PPM, what to read and what not, what to focus on, because there are some key aspects of that you absolutely must read as an investor. I don't expect you to read through 60 pages, but there are some you can't miss, right? And like Brandon said, once you read one to its entirety, it becomes more of the same thing and it's all duplicated. So it's not that hard.
Yeah, the first one is a real pain. I'm not gonna lie. Like, you gotta get yourself a glass of wine, sit down on a Sunday, get a little party, get some friends together, and try to figure it out, because you're gonna start researching a bunch of stuff, and it's gonna be like, holy smokes! But you'll start seeing that they're all relatively the same, and that's great that you're putting something together on that, because that is one thing that it always shocks me that that people sign, and maybe it's just because being in business, I've signed so many agreements and I've just learned to literally run them all through my attorney. But it just shocks me that people sign on to a bunch of things and then they get to whatever end event and they're shocked at the result. Like, well, it was all spelled out in the agreement that you signed.
Right.
Yeah, just be real careful with that stuff. I don't think people are out there to get people, but you just gotta, it sets the expectation for how it's going to operate. So you need to know what the expectations are. Otherwise you're going to have an expectation mismatch, and that's where people get upset.
Absolutely. Thank you, Brandon. I also have a presentation already on understanding what an OA is, what a PPM is, I think it's called Syndication Legalese 101 or something like that on the webinars. But I think what I want people to understand is not just what each document covers, but what are some of the things you have to pay special attention to. And I love that Brandon brought up that today, where you look at the profit and losses and understand how the losses are shared between you and the GPs and the rest of the team. So Brandon, do you have a YouTube channel?
I do, yeah.
Okay. So I will post. Can you post your YouTube channel link? There are people asking for it.
Yeah, everyone. Here we go. YouTube channel.
So this one is my YouTube channel, bit.ly/Cherry-Street.
How'd you
So,
do that? That's cool. I need
you
something.
can just go to bit.ly and create a short link. So
Oh.
you can do the real estate CPA YouTube or something. So
Huh.
that way you don't have to remember the YouTube
Right.
channel and all
Yeah.
the squiggly things in it. So
Yeah, that's good. That's good.
awesome. Thank you guys again. Have a good evening. I hope this was really useful. I know I learned a lot, so I hope you did too. Have a great evening. Thanks,
Thank you so much,
Brandon,
everyone.
again. Appreciate it so much.
Have a good one.
Bye. Hi, I'm Kavita Bartake. I hope you found this video useful, and if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.